Hi everyone, welcome to this second panel. So, is 2023 going to be the year of the stress test for private equity? Are we going to see a drop in valuation? What is going to happen in the next 12 months in fundraising? And how can we compare the current environment with previous crises that we've seen in the private equity? So today we have three panelists to help us understand these topics. So first, Piet Hein den Blanken, who is a managing director at AlpInvest. He's mostly focusing on primary investments in private equity funds. Then we have Reggie Vetaseri, who is the lead portfolio manager at Decalia, and he's focusing on private debt. And then we have Alessandro Tappi, who is the Chief Investment Officer of the European Investment Fund. And he has spent almost 30 years at the European Investment Fund, so he has a lot of experience, and I'm sure he's going to make a lot of interesting comparisons between this crisis and the previous crisis that we've seen. Myself, I am Harry van der Helst. I am the founder of Rocksling Analytics, which is a company doing analytics for private equity. So, first question. How does the current environment compare with the previous crisis that we have seen in the past? Alessandro, do you want to start?
Yeah, thanks you. Good morning, everybody. Well, we should define which crisis we are referring to, because some looked like a crisis, but then turned out not to be so tremendous. And I'm thinking about COVID, for instance. The fundamental point, in my view, is that we should see whether it is an endogenous factor that triggered the crisis or not. And there are similarities, in my view, between the current situation, although it is an external shock, as we know, and the great crisis. Why? Because I think there is a point to be made about the valuation of the investment companies at the time and here. So in my view, it is not a COVID similar case. It is not a 2000 hype on dot-coms, but there is a risk of similarities in terms of level of valuations or overvaluations of the assets. There's a second point, which probably can lead to a long discussions on the other points, the economic environment and the ability to tackle it with monetary measures. After the Great Crisis, we had a very long period of very low interest rates. In the coming years, we will not have that. So we should all be aware that any measure that can come will not be based on quantitative easing and easy money for the economy. Thank you.
Piet Hein?
Well, I would very much agree with what Alessandro just said. I think if we look back at the crises over the past 2 decades, some of them were not real or ended up being not really a crisis. So COVID, I think, is a fair example. And the key reason why COVID ended up being a non-event for financial markets is because there was a very big moves being made, particularly by central banks. Here in Europe, I think the Russia-Ukraine war might trigger very big moves again by governments. So we might end up having a very different pattern or a very different sequence of events as a result of geopolitical macro considerations that have little to do with the economy or the real economy. So it's too early to say how things will develop. Clearly, this does mark a turning point. So interest rates going up, markets slowing down, the cadence with which markets have been operating is clearly coming down, and that you don't turn around overnight or it doesn't restart very easily. So we're definitely bracing for a different period than we've had the past decade.
Thank you. Reggie, what do you think in terms of private credit and private debt? How does this compare with other episodes that we've seen?
Well, I think this is actually, every crisis has its own unique elements. And this is a very different crisis from other crises. Doesn't necessarily mean it's a worse crisis, but you've got to realize a number of things. One, it's a crisis which has been driven by higher interest rates. That has a very different impact on private debt, where on the negative side, you've got to deal with greater charges, greater burdens for some of the existing portfolio companies, but actually you're seeing an environment where your return potential is growing up. It's also a crisis which actually very interestingly is a long fuse crisis. Unlike most of the other crises that have happened in the past, we have seen this crisis predicted for about a year and a half before the real world economy properly hit. That's actually been, in many ways, not a bad thing for private debt investors, particularly those who had good covenants, because it's actually allowed people who had governance rights to start to force their portfolio companies to actually do something early in a way that hasn't been possible if you just got the COVID hit suddenly over the course of a couple of months, and the real effects of that happened almost overnight. And I think the third thing is it's also very interestingly a full employment crisis. It's very unusual for there to be a crisis which hits the economy, but actually has a labor shortage going on at the same time. And that has an impact on the kind of businesses which are affected. It obviously has an impact on the way that personal economics are impacted, because for many people, there's a huge squeeze, but there isn't a discontinuous movement. And when you put all of those things together, actually you've got to look at your portfolio in slightly different ways. And I think the third thing I'd say about this crisis, which is a bit different from others, is that something that you have to realize about any crisis is it's not just about the storm that's going on right now and how bad that storm is. It's also about whether the wind's going to be blowing in a different direction afterwards. And this crisis may well mark a turning point on a number of things which profoundly affect the debt markets and also the equity markets in consequence, which is that even after the storm's passed, interest rates aren't necessarily going to come back to the same level. There's an aspect of this which has been driven by impacts on trade flows for a variety of reasons. There may not be the same globalization trend that we've seen for the last 20 years carrying on. All of these things have very different long-term effects on portfolios, and actually may mean more for long-term private markets investors than some of the short-term up and downs.
Thanks very much. Peter, what do you think GPs are doing better? Are they better prepared for this crisis? What are they doing in their portfolio companies to protect them, and to what are they doing that they were probably not doing before, or that maybe they were doing before? What is the situation for the GPs?
So collectively, the GPs are generally or are definitely much more equipped, basically more professional, and I think many of them therefore will be better prepared. I mean, it's a case GP by GP story ultimately, if you're prepared or not. But they have a lot more tools in their toolbox to address, for example, operational issues in their portfolio. There are a lot more tools in the market to find liquidity or find financial solutions for portfolio companies. And often also GPs have a portfolio that already has a pretty flexible financial package at the underlying portfolio companies. So I think there will be less immediate stress events at the level of the GPs as a result of that, and obviously also as a result of super benign rates environment over the past couple of years. I think that puts us in a good starting point, but it obviously is no guarantee that over the medium term that will produce better outcomes.
Thanks. So now valuations. This is a topic which is on everybody's mind. We see in the secondaries market, the price that secondaries are paying on the NAV is more or less at 85 cents on the dollar for the moment, so 15% discount. it has decreased a lot, and valuations are remaining more or less stable. What is going on, Alessandro? Is that normal?
What is going on depends on the asset class and depends on the geography. We're talking about Europe here. If you compare Europe with US or Asia, you already see that there's a different outlook, in the sense that US has taken a much sharper hit on the NAV, especially the tech part. And I'm not talking about listed companies, I'm talking about VC. The past 2 quarters, there was a gap of 10 to 15 points between Europe and US in terms of devaluations. I think this will continue, and will continue in a sharper way, more acute way for venture capital. I would say a milder but probably longer effect on the private equity. And private credit, I don't claim I'm the expert, we have an expert here, but private credit is actually coming out even with better valuations than before in certain aspects. I should also say that I'm not talking about the market segments of the large buyouts and the likes. The IF is really focusing on the lower mid-market and the venture capital, so that's the part that I'm referring to. The secondaries market, which is still very, very healthy, is showing that there is an additional gap between valuations and market price. And it is a deep market, so you can't claim that it's a kind of a fire sale that drop the price, but it will be cured. I think this will continue, certainly until the year end. And we are not yet where we will be ending up.
Do you agree, Reggie? What do you think?
I think that, clearly there needs at some level to be a valuation adjustment across many parts of the private market space. That will happen, I think, as always does in private markets, over an extended period of time. So to one of your sort of earlier sub-questions, will there be a sort of a giant valuation drop in Q4? I don't think there will be. There will be a gradual adjustment of private markets valuations in private equity in particular over an extended period of time as people work out whether the pricing that you see in the secondary markets, which is impacted by views on future market conditions and future valuations, but is also affected by liquidity considerations and supply-demand balances in the secondary market, really reflects what people see as the long-term hit to their portfolios. But at some point that will need to happen. And I think more than in some market segments where a hit needs to occur, you may not be able to get back to a stage where you just wait forever and you grow back into your old valuation. And the reason for that is particularly in things like the VC space. If you never go back to the level of interest rates you had before, you may never have the same multiple that you had before. And if you never reach the same level of growth before, you will therefore not have the same level of multiple. So you can only wait for your portfolio to grow organically into its valuation, and that may be a very long period of adjustment, and that may need to take some more valuation hits rather than flat valuations. In the private credit space particularly, it's a slightly different situation, because here you should be, on your principal, protected until you're impaired. So what we're seeing at the moment is not many companies are at the situation where it's obvious that they're going to face a default. That will become clearer for those companies who are in trouble over the course of 2023. Hopefully many of those companies, it won't happen, and therefore the current valuations will make sense. But those valuations will only take that hit, and you don't have the mark-to-market effect that you have in public markets. So it's natural that actually that market is having the resilience it's designed to have. And that's what effectively people are buying when they purchase those portfolios.
Is there anything you want to add, Pieter, to that on valuations?
No, I agree with all those points. I think the supply-demand balance or imbalance in the secondary market is going to be tested quite seriously in the coming year. So there's a lot of big LP allocators who allocate to private equity who are talking about preparing big LP secondary portfolios, sales, and yeah, if you add those all up together and they actually happen, it will really test the depth of the secondary market. And that will certainly have an effect on the pricing you'll see on those deals as well. So it's going to be an exciting year.
Thank you. So moving on to fundraising. So we see that the environment is quite challenging for private equity, interesting environment with raising interest rates. There is more competition, so the returns, the trend on the returns over the past 30 years is more decreasing. Is this year a threat to the PE market? And then we can speak also about private credit, but for the private equity market, Alessandro, what do you think?
It's the worst of the three questions you ask. It's a very painful situation in my view, and it will get worse. No surprise that in most surveys, GPs indicate their first concern being fundraising. We see it ourselves in the time to market of funds. It has already lengthened a lot, and many funds are not making it to the first closing in a kind of usual way as we saw it in the past years. And there is a migration towards a certain breed of GPs. For instance, first-time team are the last one to be considered. Investors tend to go to the known fund managers and allocate or re-up their investments with them, and let the new ventures to be assessed at a later stage. And indeed, there is a more competition with other asset classes, which makes also begs the question to what extent the institutional investors will be able to stay in the market, and for how long this will continue.
Piet Hein, does that also improve the terms that you get on fund? That you will get?
Certainly, if we have a say in it, yes. I mean, the past few years, fundraising was also surprisingly easy for many managers. And as a primary investor, as an LP, I don't mind fundraising to be a bit harder, a bit sort of slower. You know, the balance of power between GPs and LPs in the past few years was very much on the GP side. So as an investor, I don't think I mind a bit of a change there. You know, longer term, I think the fundamentals for private equity as a concept, as a way of investing, as a way of as an ownership/governance model for portfolio companies is still, the fundamentals are still very good, and the underlying drivers that increase the penetration of private equity in the broader economy are still there. So I very much believe that the secular trend will over time be more relevant and more important than short-term fluctuations. Even if this year is a difficult year with slowdown, the medium to long-term view, from my perspective, is very much untouched at this point.
Reggie, we've seen in the past few weeks a few pension plans in the US switching to bonds. Do you think that in the next 12 months we're going to see the allocation move to other assets, private credit, infrastructure, and leaving the private equity space?
So I think that more generally, you know, as I was talking about a little bit earlier, we're seeing a shift in the interest rate pattern. We're probably going to have higher interest rates over a longer period of time, and that essentially is a shift in the balance of power between lenders and equity holders. And that should allow for higher relative returns relative to where they've been previously, relative differential returns for debt holders relative to equity holders. And I think that may impact the way that people allocate, as well as the fact that people are also thinking still defensively now, as we still don't know whether we're at the bottom of the crisis. And I think we can certainly see that in some of the behaviors, both in the liquid and the public and the private credit side. There is a question which people often ask, which I think you're getting at as well, which is sometimes the argument for private credit has been made, well, you can't get any return in a liquid complex where interest rates are practically zero. This is why you need to do private credit. When you can get 5%, even 7% returns on high yield bonds, what's the point of private credit? Well, I think the answer to that is that the private credit returns also need to go up commensurately. And I think you actually do see that happening in large parts of the market. There's a big floating rate element of the private debt market. There is an opportunistic element, which actually ought to mean that the kinds of things that private debt are best at, especially outside the sort of sponsored lending space, which is impacted by sponsored deal flow, will benefit even more. And that means that that premium ought to remain. And I think we are seeing that, at least in the deal flow that we see at the moment, but that's a question that people ask at the moment.
Thanks very much. Looking at the audience, are there any questions? Nobody? So I've asked each panelist to prepare a outrageous prediction for the next 12 months, which is meant to be entertaining, thought-provoking. It doesn't reflect what they think is really going to happen in the next 12 months, but it's just to fuel the discussion and have a bit of fun. So who wants to start? Reggie, do you want to start?
So I think my prediction is that we're going to spend the next 12 months making far too many predictions and actually doing far too little. And, flippancy aside, what I mean by that is that when we're at this stage in a cycle, people spend a lot of time thinking, are we at the bottom yet? And lurching between sort of despair as they imagine another sort of like leg downwards, and ebullience as they see some tiny signal from the Fed or something, or some comment from their liquid markets colleagues, meaning we're back in the sort of most opportunistic part of the market. And actually, as private markets investors, sometimes that leads to either paralysis or spending our money too quickly. And often, by the way, the challenge in a market is not spotting the bottom. It's having money left when you actually are at the bottom so that you can invest in that best point in the market. What we really need to be doing, I think, at this stage in the cycle is being disciplined, realizing that in private markets terms, we are at the bottom because the bottom is not a moment. It's a window of actually about 2, maybe even 3, but normally about 2 years, which we are in. And you want to be disciplined about choosing attractive opportunities during that period, realizing you should let some go because other opportunities will come along, and continuing to invest in what could be a very interesting opportunity if you're willing to stay the course, as we by definition are, if we're investing in this asset class.
Pete Hain, what do you think is going to happen? What is your prediction?
I don't have an outrageous prediction, Harry. I know, disappointing you here. No, I would say I would very much agree with Reggie's point. It basically is around short-term versus medium to long-term. And 2023 might see things get worse before they get better, but I wouldn't be surprised if for the private equity industry at large, this ends up being a far smaller blip than people today think or talk about.
The best for the end.
Yeah, Peter, I just used the word that I was thinking about, the blip. If we project ourselves in 5 or 10 years' time from now, you will see the curves, and you will see another little blip in 2002, 2003 about valuations, and everything will be fine. Part of this is linked to my outrageous thinking that we are almost at the end of the devaluation, so we are touching the trough. And there is, in the underlying economy, strong megatrends that allow companies to create value in a steady way. Hence, there will be a fast recovery from where we are or where we are going. What is the black part of this? Maybe the most outrageous thinking here. Funds need deeper pockets to support their portfolio companies. They need to be bigger and more resilient. There will be far less funds in the future, maybe 30% fewer.
So consolidation, you mean? People buying other...
Yes.
Oh, that's interesting. I think this is a good conclusion. Thanks very much.
Thank you.
Thank you.